So as a reminder, for this webinar, you are recorded. I hope you're catching the recordings online. My son Max is doing a great job of editing the videos and putting them up on the website so that you can download them, have access to them, share them with your friends. That's certainly happening because I'm getting random emails from people who I've never heard of or met before, but I'm always glad to see more people, joining the fold, so to speak. So I hope you continue to enjoy these educational webinars, and I'm always looking for any kind of feedback, whether it's, hey, you did a great job, I appreciate that, or you could do this differently. That makes these webinars better and helps bring you better content. So as a reminder, we are recording, of course. There is a Q&A at the bottom of the screen. You are muted. The chat should be disabled. So if you have a question, type it into the Q&A. I'll check in periodically. We typically go 45 to a full hour, 45 minutes to a full hour. We first do about 15 minutes of slot updates. So from the Ed Slot group, I look through articles to see what may interest you and keep you informed and on top of things, because we know you've heard these things before. But, I'm thinking of one person in particular, and I'm not sure if he's on the webinar today or not, but this individual calls me from time to time with things that he's heard from other financial planners or advisors that he works with, including one large firm. And he was told that Roth conversions are at risk of being eliminated by the Build Back Better plan. And the group that he works with actually told him that he should not be doing Roth conversions because it could retroactively be overturned, and that is nowhere in the chopping block. There was discussion about reducing the ability for high income earners. I think it was at 600,000 or maybe 400,000, which seems to be their kind of chopping block there. But high income earners to not be able to do Roth conversions. But that in the Build Back Better plan, that was slated to begin 10 years after the law was enacted. So nowhere was there discussion about eliminating Roth conversions. And this is a large group. I'm not talking about just a small mom and pop group and somebody got it wrong. This is a large financial institution that frankly should know better and shouldn't be telling their clients this information. And there's been other things, bits and pieces that were wrong and kind of halfway understood. And that happens all the time. Talked about it, I think, last week or the week before. People often confused for retirement age for Social Security with actual retirement age or collection of pensions, or 70 and a half and 72 for required minimum distribution. So it's, 59 and a half. There's all these crazy dates, and you've got to keep these things straight, or we do. And it's difficult for you folks. So repetition, I think, is good. So if you've heard this, some of the things I talk about in the slot report, I talk about RMDs a lot. I talk about, today I'm going to talk about the 5-year rule. And I almost loathe speaking about the 5-year rule because somebody's going to write me a question about it. The 5-year rule can seem really complex, but it's really quite simple when you look at it. And I think Sarah does a good job talking about it today. So that's why I'm going to share it with you. And speaking of Sarah Brenner, so coming up on March 16th, Sarah is going to be joining us on our special webinar at 6:30 p.m. That's a Wednesday, March 16th, the special webinar. You, of course, will receive an invitation. And we're going to talk about trusts as beneficiaries of an IRA. So something that is common. Well, I would say something that's not uncommon. So maybe that just by default makes it common, but it can be very beneficial, but it can also have significant concerns. So always good to know what you're getting into there. We do have a Changing World of Retirement Planning class. So that is David McKnight's program that I bring to you, Changing World of Retirement Planning class. That's going to be a webinar, not quite ready for an in-person class yet. That will be beginning March 3rd and March 10th. So we have 2 evening series. It's a total of 6 hours between 2 evenings, 3 hours and 3 hours. We have the 3rd of March and the 10th of March. They're Thursdays. And then the 8th of March and the 15th of March, they are Tuesdays. So you can do back-to-back Tuesdays. You can do back-to-back Thursdays. You can do, the first Thursday and the second Tuesday. You know, you can mix it up however you want to. Most people just stay in the channel that they're in. But that's coming up. You'll receive an invitation to that as soon as invitations are ready. I suspect that to be in the next couple of weeks. All right. David McKnight, of course, is joining us on April 27th live in Newtown. That will be exciting. We're going to have a special VIP event for you folks. So look out for that. And as always, you should be listening to David's podcast if you do podcasts. You know, I'm just at the end now of my of one of my current podcasts, and it has to do with Sopranos. I think it's called Talking Sopranos, and it's a lot of fun if you're a Sopranos fan. But one I always spend time listening to, and I often catch up on it. I'll listen to 2 or 3 at a time as David's podcast. So I know you're interested in learning more about these things, you should, and that's a good resource. So, and then today in planning, so we're going to talk about the slot report or slot mailbag. We're going to talk a bit about the markets and what I'm seeing from some analysts. And from a financial planning point of view, we're going to talk about knowing your numbers. So one of my TV shows that I like to watch, I record and I watch it when I can. It's called The Profit, and it's on CNBC. I don't know if you've ever watched it, but it's a billionaire who goes into small family-owned businesses and reviews the business, and sometimes invests in the business and helps them. Sometimes he doesn't, but it's interesting. But he always says you got to know your numbers when you're talking about business owners, and it's the same thing for planning, for financial planning. And we're going to talk about some details about how to really know your numbers. And this webinar today, we're going to talk about expenses. Next week, we're going to talk about income and withdrawal. So we're going to focus on expenses first, what you have to fill, right? And then how you get there, we're going to talk about next week. So that should be some fun financial planning discussion. Okay, so let's dig into the slot reports. No questions yet. I appreciate it. And this one, as I said, has to do with the 5-year rule. So the 5-year rule is a rule for Roth contributions and Roth conversions. It says you must have a Roth IRA funds in a Roth IRA for at least 5 years for 2 things to happen. First is to be able to withdraw tax-free, to be able to withdraw the growth tax-free. The second thing is if you're under 59.5, to be able to access the funds without a 10% penalty. So the 5-year rule can get very confusing, especially when you're under 59.5, but it's very simple over 59.5. So let me just read Sarah's letter, and I'll try to clarify it if need be along the way. So Sarah writes, this is not a response. It's just it's a kind of an article she wrote. If you're under age 59.5 and you converted your traditional IRA to a Roth IRA, you will need to watch out for the 5-year rule for penalty-free distributions of converted funds. Not understanding how the rule works can result in unexpected penalties when you withdraw your Roth IRA funds. I want you to remember that she's talking about under 59.5. If you make annual tax-free tax year contributions to your Roth IRA, you can always access those funds tax and penalty free. So contributions, you can always access tax and penalty free. That is pretty easy to understand, she writes. There is what the IRS calls ordering rules. Ordering rules say that if you want to draw money out of your Roth IRA, and they are not yet, you haven't met the 5-year rule, they first withdraw any contributions. Second, they'll count any withdrawals as conversions. Third and last is any growth. So, however, when it comes to converted funds, it gets a little more complicated. You can always access your converted funds tax-free, even if you are under 59.5. That makes sense because you already paid the tax bill, she says, when you did the conversion. It's a different story, though, when it comes to the 10% early distribution penalty. If you're under 59.5, you must satisfy a 5-year holding period on funds that were taxable when converted before you can access those funds penalty-free. The 5-year holding period will restart for each conversion and is effective as of January 1 of the year of the conversion. If the conversion was done anytime in 2022, for example, the holding period for this 5-year rule begins on January 1st, 2022. So even if you did your conversion on December 31st, 2022, in this example, it counts as though it was done January 1st. The best way to understand this 5-year rule for penalty-free distributions of converted funds is to know exactly what it is set up to prevent. I like the way she set this up because it makes sense kind of backing into, wait a minute, this 5-year rule is confusing. What about this 10-year 10% penalty? Why in the world would I have a 10% penalty if I've already paid tax on those funds? Why does it matter? Well, when you take a distribution from your traditional IRA and convert it to a Roth IRA, that distribution is taxable, but not subject to the 10% early distribution penalty. Again, if you're under 59.5. This fact meant that soon after Roth IRAs became law, those looking for tax loopholes started advising under 59.5 IRA owners that they could get out of the 10% penalty by doing a conversion. So there were some savvy people out there that said, well, wait a minute, this new Roth allows you to do this thing called a conversion. So you can pay tax now on your IRA, put it in a Roth IRA. But if you don't want to pay the 10% distribution on that IRA, you can now just take it out of the Roth. So it created this loophole. IRA owners could just convert their IRA to a Roth IRA and then the next day withdraw funds from the Roth IRA, tax and penalty free. So they paid the tax on the conversion and then no 10% penalty. Congress quickly shut down this loophole and now we have the conversion 5-year rule. If the converted funds are not held for at least 5 years or until 59.5, any withdrawal before that time would be subject to 10% penalty. The account owner would have paid if she or he had withdrawn from a traditional IRA. So I think that's pretty simple. I think you do too. Most of my clients are beyond the 59.5 threshold. So usually not something to worry about. Most people are coming to us in their early to mid 60s, sometimes in their 70s. So that is really not an issue for them. And the reason it's not an issue is, and Sarah writes, don't confuse this conversion 5-year rule with the other 5-year rule, the forever 5-year rule. That also applies to Roth IRAs. The forever 5-year rule determines whether distributions of earnings from Roth IRAs are tax-free. That rule works differently from the conversion rule. The forever rule for tax-free distribution always applies no matter what your age is. Also, it begins with your first contribution or conversion to any Roth IRA, and it never restarts even if future contributions or conversions are made. So this section didn't clarify it the way I thought it was going to, but if you're over 59.5, as long as you have one and a single Roth IRA that's older than 5 years, whether you're talking about conversions or contributions, you're really in good shape. So it gets very, very simple after 59.5. It gets more challenging over 59.5 because, again, with the conversions, if they're always tax-free, the 5-year rule really applies to the 10% penalty if you're under 59.5, right? As long as you met that 5-year threshold. Okay, so I don't see any questions on that. I hope that all made sense. So the 5-year rule is confusing, but again, once you get over 59.5, it's very, very simple. I can't think of anyone who we've really run into the issue with that. Most of the time when we're setting up Roth conversions, we're doing it in a very systematic way. So the first, of course, is determining from an expense and planning point of view how much you should be converting, because you really don't want to convert funds that you're going to be needing next year anyway, right? You want those conversion funds to be able to grow. So you have that systematic plan that's based on your income level, your taxable income, to be able to convert as much as you can while making the tax as comfortable as it can be on those conversions. But you also want those Roth funds to be in there for, at least a few years, a good number of years, at least 5 years, let's say, before you start drawing on them, so that first of all, you benefit from the tax-free nature of them, of any growth, but also when we're looking at making plans tax efficient, often usually we're trying to draw down the tax deferred bucket. So we want to use those funds, not just for conversions, but for spend down as well, if we don't have significant funds in the taxable account. So we don't run into that too often, but it's always a question people have. What about this 5-year rule? Can I not touch that for 5 years? And That's not true. If your back's against the wall and you need to access that money, you certainly can. And I talked about the ordering rules. So now let's talk about the markets. So everybody's talking about the markets right now, and we were up slightly. Just looking at my screen, I don't see where we are right now, but last week, ending Friday, the markets, general markets, were all positive. Dow Jones was up a little over 1%. The S&P 500 was up a little over 1.5%. The NASDAQ was up 2.41%. The global indices were 2% overall, but year to date, they're all still down. Negative 3.35 for the Dow Jones, negative 5.5 for the S&P 500, negative almost 10 for the NASDAQ. And globally, negative 3 to 5%, let's just say, or 7, actually, I see. So year to date, we're still down. What's challenging, of course, from an investor point of view is that that's stocks, right? The markets, the stock markets, the fixed income or bond markets are also down. So the Barclays aggregate bond index, what we commonly follow for, intermediate term bonds, is down 3%. So the Dow Jones Industrial Average is down 3%. The aggregate bond index is down 3%. So that can be challenging from an investor point of view when you say, well, wait a minute, I'm supposed to offset the risk of stocks with bonds. Now they're both down the same. What does that mean, and why is it working that way? And if you've been paying attention to these webinars, you've heard me say that, the bonds are the most trickiest place to invest right now, I believe. And I've been saying that probably for, I don't know, it feels like forever, but at least a year or more. And it's the area that keeps me up at night. It's stocks don't worry me as much. But we've had this spectacular run up over decades. It feels like certainly more than a decade in bond markets. And we're looking at rising interest rates for sure. And that's a challenging environment for the unmanaged index. And it's even a challenging environment for the managed, bond managers, managed mutual funds. It's the area that concerns me the most right now. The Fed funds target rate is still 0.25%. 1 year ago, it was 0.25%. So the Fed hasn't raised rates yet. They're talking about doing it in March, and they're talking about raising it several times. But the market's already reacting, right? The bond market is reacting to the potential raise in Fed funds rate, and so is the stock market reacting to this potential or certain raise in the Fed funds rate. So it doesn't always, the Fed controls interest rates, but it's also driven by the market. So it's really going to be interesting to see what happens over the next 12 months, how many raises the Fed does, if that helps balance inflation at all. We're seeing some stronger employment numbers, although, it seems like you still can't get much out there. So, it's still challenging for sure out there. So that's a snapshot of the market. So you've got to tread carefully. I go back to that foundation. You've got to have that foundation in place, and you have to change it on a regular basis. So we'll be doing, as every quarter, we do a review of our investment structures, and we will certainly be making some changes. I'm assuming to our bond allocations. But as I said, it's a challenging environment. Okay, so let's see here. I'm going to spend a little bit of time on Blackrock today. So whether you love or hate Blackrock, they certainly are a leader in investment direction in the world. And before I get into Blackrock, because it's going to take a little bit of time, I just want to share with you Riverfront again. So I wrote Riverfront an email yesterday when I read this report, but their key takeaways for the week. I do like that they just give some bulleted takeaways, and of course they back it up with a longer piece. But Riverfront reads, recent volatility around earnings headlines obscures underlying earnings power in our view. Really, where are earnings going to be with the companies that we invest in, U.S. companies and global companies for that matter? The U.S. economy remains strong, giving us greater confidence in our expectation for mid to high single-digit growth for S&P 500 earnings not mid to high single digit growth of stock of their investments, but of their earnings in 2022. That doesn't always match, but often it does. And then they end with, we believe volatility will persist through 2022, but remain constructive on equity. So I can't stand that phrase. I just don't know what it means. So I know we had a bit of a discussion about it last week, but I did write to them and I said, please give me your definition of constructive, because this is, I don't know, an umpteenth time that they've used it, and they're losing my confidence there with their analysis. So let's go back to BlackRock. So there were key points where more rate hikes, markets are pricing in ever more rate hikes amid hawkish policy signals. So that just means hawkish means the Fed is saying we're going to raise rates and showing that interest rates are going to be raised. We see the eventual outcome as being more benign, but brace for volatility along the way. So BlackRock, to my understanding, is saying we don't think it's going to be as aggressive as maybe the Fed is signaling, but it's going to be volatile. So brace for it along the way. Bond yields rose across the globe after hawkish policy moves. That same language. Record euro area inflation and much stronger than expected U.S. employment trends. So bonds, that's why we see those yields rose. So not only is that Fed pushing interest rates, going to raise rates. They said they're going to raise rates, but the bond market is saying, okay, we're driving up yields. And that, of course, drives down bond values. We have some consumer price index releases coming this week. So that's going to have discussion. And they say, is it this week? No, I guess it's not. But the consumer price index will be in focus as Fed is set to start raising rates amid 40-year high inflation. We still see a historically low sum of total rate hikes supporting stocks. So they're saying, again, they just don't think that it's going to be as aggressive as they're signaling. So they have, I took some time over the weekend to read their 2022 investment themes. And they have 3 that I thought would be interesting to share with you. And again, we use these analyst reports. We don't want to say, okay, well, geez, BlackRock is underweighting X, so we should do that as well. We just want to gather information from the big and the small players, right? So Riverfront is a good example. They're compared to BlackRock, they're a very small investment management firm, but in the past they've been very, very good, and as from a research point of view and analysis point of view. I'm not that impressed with them for the last several months, but that doesn't mean I want to throw them away. But again, we don't make the decisions based on exactly what they're saying. We use their information to fuel our own decisions on investments. So BlackRock says one of their first themes is living with inflation. We expect inflation to be persistent and settle above pre-COVID levels. So above where we were before COVID. We expect central banks to kick off rate hikes, but remain more tolerant of price pressures, keeping real interest rates historically low and supportive of risk assets. So they're saying that rates will continue to be lower, right? So remember where we should be. The 10-year Treasury, which is about 1.7% right now, should be at about, let me just check that, should be at about 5.5. No, I'm sorry, 10-year Treasury is 1.91. The week prior, the end of January, it was 1.77. So they're saying that while they expect inflation to be high, they're expecting interest rates to stay relatively low. So I'm not sure what they mean by relatively low, but if the average should be 5.5, I would expect that we're coming in at about 3.5%. We're at 1.9. That's a pretty good movement there. If we're at 3 to 3.5%. They say about inflation is being driven by unusual restart dynamics of extraordinary demand bumping up against supply bottlenecks, right? So we're catching up on the supply restrictions that we had. And of course, we all know that it's harder to get things. I'm waiting for windows for a project for Newtown, and we just don't know when they're going to be there. And there's, metal for our roof. There's all kinds of things out there that people are having a hard time getting. You go into a grocery store and we witness things we haven't witnessed in my lifetime, where there's just bare spaces on the shelves. So we're not used to that certainly in this area and in this country. We expect many supply-demand imbalances to resolve over the year, they say. The policy response to rising inflation isn't uniform. Developed markets, central banks have already demonstrated that they're more tolerant of inflation, even as several are gearing off to kick interest rates with steeper initial increases. The Bank of England and many emerging markets counterparts have already began raising rates. The Fed has achieved its new inflation goal to make up for past misses and sees it has met its full employment mandate. So it's already feels that it's met that mandate for full employment. Now they got to focus on inflation. This is justification. And listen, nobody is arguing that the Fed hasn't missed along the way. But these are bright individuals, and it's really challenging if you're the one kind of making the decisions and pulling the levers. Suddenly you're deciding to raise interest rates, and the market's going to fall, and that people are going to be panicked and concerned, and millions of people are retiring every day. So there's a lot of weight behind that. This is justification for kicking off rates soon, rate hikes soon, likely in March. Still, we believe the total sum, they're repeating this, the total sum of rate hikes to be unchanged and historically muted. And that's more important to markets. So they think that it's going to be smaller than others are predicting. And I think that's an interesting take. The Fed has sped up its tapering of bond purchases. So that's where the country issues bonds, US bonds, and then prints money to buy them back. So we needed to stop that because that adds to inflation, devalues our money. And the Fed has done that. They've started to taper that back. They've actually sped up what they had planned, and has indicated it may start to trim its balance sheet earlier than expected by letting bonds run off when they mature. So they're not going to reissue. They're going to mature, and then they're not going to reissue. The European Central Bank also indicated it may wrap up its asset purchases earlier than expected. That's positive, I believe. Investment implications: we prefer equities over fixed income and remain overweight inflation-linked bonds. That's interesting. Cutting through the confusion is their next section. A unique mix of events, the restart of economic activities, virus strains, supply-driven inflation, and central bank frameworks could cause the markets and policymakers to misread the current surge in inflation. So this is interesting. They're basically saying that this could cause a miss, not just in the US, but around the world, where, if we're too aggressive in our raising of interest rates, it could dramatically hurt the market, and we could be climbing out of that for some time. There's also a risk markets misread China's policy. The country has emphasized social objectives and quality growth over quantity and regulatory crackdowns that have spooked many investors. Yet policymakers can no longer ignore the growth slowdown, and we expect incremental loosening across three pillars: monetary, fiscal, and regulatory. So, China is a big concern as far as, it's a big driver in the U.S. And there have been some shifts in China's economic policy, and it's really yet to be seen how that plays out. Investment implication, they write, we have trimmed risk-taking amid increasing risks. Central banks may slam on the brakes. So while they're overweighting stocks, they're looking for less risky positions in their stocks, is how I would read that. And then they go on to talk about climate risk. Navigating the next net zero is their next section. Sustainability costs, cuts across multiple dimensions, the outlook for inflation, geopolitics, and policy. The green transition comes with costs and higher inflation, yet the economic outlook is brighter than a scenario of no climate action or a disorderly transition. Listen, it's very clear that there is a push towards a more green approach to things. And you can, if you go too far on it, it can be challenging, or people can see it as negative. If you just ignore the effect that we have on our world, that can be damaging as well. But we're seeing, I've been a big fan of the electric vehicles for some time. I own one. I've invested in them. This is not a recommendation to invest in any sector or product, but we're seeing a lot of competition in that area. Solar power being able to be brought into the homes. I looked at that many years ago, and it was very expensive. We had a solar panel on our house when we bought it. It was this crazy, the kind that the liquid ran through, and it was like a big unmaintained sail on my house. It was actually cooling water when it went up, and it was completely inefficient. So I learned something from that, because that technology was decades old. And when I was looking at solar panels for my house, first of all, at the time we had too many trees and it wouldn't work, but I'd like to have that evaluation again, because things have changed in the 13 years since we bought this house. So there's no doubt that there's a push towards that. Some people feel very, very strongly on both sides of that, but most of us, I think, run in the middle and see that it's 10 years from now, what we drive, how we live, how we use fossil fuels and deal with carbon emissions is going to be completely different. So I think it's very interesting. So investment implications, they write, we favor developed market stocks over emerging markets as we see them as better positioned in the green transition. I think that's interesting as well. I'm going to share this chart with you, and then we're going to move on to the financial planning topic. And this was just a good visual. This is coming right on my notes here. Okay, you should see something that says selected asset performance. Ken raised his hand immediately before I even said it. Thanks, Ken. All right, selected asset performance 2022 year to date range. I thought this was an interesting snapshot because I just want to show you what we're looking at here. So this is the zero line, right? So anything to the right is a positive, anything to the left is a negative. So oil, Brent crude, is obviously up. It went, so this tells us how high it's been so far this year and where it is at the time of this report. US dollar index has fluctuated a little bit. It's here. Gold has fluctuated a little bit. It's down right now. Emerging markets equity, so smaller, not necessarily smaller countries, but smaller economies. That's down, right? You see the swing here. The 10-year bond for Italy, European stocks. This is equities, wherever you see stocks. This has been the swing. Look, it's been as low as here. And then jump down here to US stocks, US equity stocks, up slightly, but pretty far down as 10%. But it's sitting kind of right down here at 3. What did we say? 3.5, just about here. But the U.S. Treasury, look at that. It's right about -3 right here, right? So it's 10-year Treasury we just talked about. But it's still pretty darn close to the bottom there. So not much. My point being, not much on this positive side. Now it's only the 8th of February. Let's just hope that we have some positive growth. But folks, I told you in the beginning of the year, I think this is where we live, for the year. I don't know if I can draw on this. Let's see. But I think this is where, when we look back, yeah, I can. I think this is where we live. I think that we're going to see at the end of the year, when we price this in, maybe some positive here, but maybe some negative. But this is kind of, I think, our 2022 track. So I thought that was a good look at that, and I hope that was beneficial. So let me stop my share before I move on. So I'll share something I shouldn't. All right, so just raise your hand for me if you can see my whiteboard. Thank you again. Ken is quick on the trigger. Thank you. All right, so you're going to see me looking down as always, because I'm going to draw on this whiteboard for you. So we're going to talk about knowing your numbers, and specifically we're going to talk this week about expenses. Next week we're going to talk about income and withdrawals. This may seem really simple, but it's not. And this is where true financial planning makes a difference. I will tell you that I've been using planning tools for many, many years, starting at my time at UBS, Painewebber. And most of the time, if this is, to use the iceberg, kind of analogy, let's just fill that in. And this is the entirety of the planning tool. Most of the time, this is what's being used. And there is a whole depth here underneath that most financial planners, most advisors, certainly most investment firms aren't even touching. And why does that matter to you? Well, because you've got to understand, you know, just like ships going by, that might be wide of this, but it might be what's jetting out under here in this berg that catches them. You have to know the same concerns and how to navigate around it or how to identify it. So if you're not doing the work, either you aren't doing the work or you and your planner, you and your team aren't doing the work, then you've got a tremendous amount of risk. And while it might be okay, you know, it could be devastating as well, because there's a lot of unknown floaters out there. And if you're either just shutting your eyes off to it or not paying attention to it, then it can be devastating. So, you know, we spend a lot of time on our boxes, right? Our buckets, and we know where our investments live. So we have taxable, we all know this, tax deferred, and tax-free or tax advantaged. And you all are experts at this now. So this is taxable. Any, you know, whatever you get 1099s for, you're getting them right now. Not 1099s ours, but 1099s for interest, dividends, short-term gains, long-term gains. This tax deferred is anything you got to promise to pay later. And of course, tax-free is anything Roth. You've already paid your tax. You don't pay any tax on the gains as long as you follow the rules. And properly structured cash valuable life insurance. They're the two things that are the only two things that are truly tax-free. And then if I'm mapping out, you know, so we know what your assets are in here, right? And we're not going to go into the details. And we want to make sure, of course, that you just maintain a mathematically ideal amount. And then you have everything else over here. So most of your money should live here, ideally, in your plan. And of course, we've come up with ways to do that. And then we have these areas here, and I'm simplifying just kind of in a drawing, just showing you the basics of a plan. You have your expenses, and you have your income. And people will say, well, I'm going to get, you know, $35,000 from Social Security, and my wife will get $30,000. My spouse will get Social Security, or maybe it's just me, but this is what you have coming in. Some people have a pension, you know, $10,000, let's just say. And then when we get to expenses, whether it's on a questionnaire or just having a discussion, people say, I need $5,000 a month, you know, or $60,000 a year, or I need $10,000 a month, or $120,000 a year. And most people just take that information. Okay, good. Let's run with that, right? And they develop a plan, and you end up with this cash flow chart that shows, you know, this is how your money's going to grow, and you're going to have some funds coming out of it, right? So you might have a line that kind of, you know, the expenses kind of run, you know, like that, and your assets grow. You may have seen something like that. But that's just taking that into account. That's $60,000 or $120,000 a year. And it's so much deeper than that. And the work has to be done. So how do you do the work? Well, first of all, you have to identify specific needs. How do we identify specific needs? I've developed this spreadsheet. I'm going to share it with you. Over many years, that helps shake things loose. Now, for whatever reason, I have a lot of engineers who work with us. So I don't know why. I appreciate them, and I don't want to say I understand, you know, what they do or how they think, because I'm not an engineer. But they're very generally. I don't want to generalize, but I'm going to. They're. I don't know why I can't get this smaller. That's what I'm trying to do, is so you can see all the categories. It's not pinching down. I don't like that. Okay, I'll just move it down when we get there. Now it's sideways. All right. So generally, engineers are very detailed oriented. And even those folks who come in and say, oh yeah, I know it's $60,000, it's $120,000 a year. I keep everything on a spreadsheet, or I keep everything quick, and I know exactly what it is. I go through it every month. Even those folks, I can't think of an exception, will not be thinking of something. we want to make sure that your expenses are taken care of. But we also want to make sure that you've got some fun written into that plan. Movies, shows, travel, dinners, whatever is something you want to do, golf, boating, whatever it is for you. So we want to make sure that that's all part of it. And this sheet helps to shake that out. Now, I'm going to share with you where you can grab this sheet for now. And I say for now, because in 2020, things are going to be changing. So if you go, you should see my homepage here. So just raise your hand if you see the Attleboro Wealth Management homepage. Thank you, Walter. Good to see you. If you go into services and then you scroll down to financial planning and you click into there, we have a whole section here of financial planning. It talks about the code of ethics and standards of conduct for a certified financial planner, why it's important to work with a certified financial planner, how we help you plan for success, what we go over, your goals and objectives, investments, tax, insurance, wills and estates. I outlined our, what a potential 8-week process looks like. That we have an 8-week process for financial planning. And down here for now, I have some links. You can click into the expense worksheet here. It'll download a spreadsheet onto your computer. There's also the confidential planning questionnaire. You can use that as well to keep records. I say for now, because in 2022, what one of our goals is, and I hope we are able to achieve this in 2022, is to make this a member-based platform. So clients will, of course, will have log on. You can go in and see anything you need, but all of our training videos, all of our intellectual property like this will be password protected. So it's only members of the organization or clients of the organization that will be able to have access to it. Right now, though, you can still download it. So take advantage of that if you'd like, but that's how you access that. So let me go back to the whiteboard. Okay, so here's the spreadsheet. So some people print this out and write in it, and some people fill it in as they go on here. But there are areas that people often miss, and you need to see a couple different things. You see this mortgage? Whoops. Okay, this is not behaving well today. Let's see here. Can you see that? The mortgage. I'm going to put a check by it. Down later on here, we have property taxes. So many people. And then there's a section here of insurance. So this is just one example, because if you still have a mortgage, most people say, okay, my mortgage is, $3,000 a month. Well, almost certainly that includes property taxes and insurance, homeowners insurance. We want to separate them out because there are forever expenses and short-term expenses. Well, you may only have 10 more years or 5 more years or whatever on your mortgage. And if you're planning that, if $2,300 a month is your principal and interest of your mortgage and only $700 a month is the rest of it, well, if we just take your word for it, my mortgage is $3,000 a month, and we assume that $3,000 a month is there for the rest of your life, 95, 100 years old, then it's not going to be an accurate plan. It could either limit the amount that you're comfortable spending during your lifetime, or it could show a negative. It could show that you run out of money at a point in time, and that's not good either, right? To give you that feeling that you can't achieve what you want to achieve when the information is incorrect. Now, it could be that, and this has happened. We've had people who come in and they say, we really dig into the expenses. And they'll say, I've been working with a financial advisor for the past X number of years. Sometimes it's decades. And he or she's told me that I'm going to be just fine. You're telling me that I could potentially run out of money at age 85. Well, again, the difference is the work hasn't been done. The work hasn't been done to really dig into the expenses. Separate your mortgage and principal and property taxes and insurance. I often hear things like this. I didn't think about this area here. Hopefully I can map this out. I'm down here on the bottom right. If you can't see it, pets. And I've heard, I can't believe I spend $5,000 a year on pets. Charitable donations. People sometimes donate more than they think they do. This is something that can be turned on and turned off more easily than other expenses. But listen, if you're paying $5,000 a year on pets, and you're a pet lover, you can't just say, you know what, I'm not going to do that. Most people don't. This big area, medical, huge, right? When you really dig into what those costs are. Now, if you're over age 65 and you're already on Medicare, it's likely you've got a pretty good handle on this. If you're under 65, you probably really have no idea. If you're not 60 yet, this isn't even on your radar. So we know that the average in our area, the average person has about, let's just call it $5,500, average healthy individual of out-of-pocket expenses after they start on Medicare. That's per individual. So the math is easy, right? That's $11,000 for a couple. And that inflates at about 5% a year. So that gets out of control really quickly, I think. And we have to account for that. Even if you're not thinking about it, we are. And if you don't fill in, if your fill-ins here don't amount to $5,500 for an individual, then, and let's just say you say, well, I spend about $1,000 a year of, co-pays and things like that. Then we're adding in $4,500 a year for medical expenses after Medicare. And we inflate that at 5% a year. Now, you might say that I'm never going to spend that, but that is the average Medicare gives us for our area, or for your area. It used to be a national average. Now it's very specific. They have all the data, so I am not going to argue with it. But you'll see that now listen, this spreadsheet evolves. It's changed in the past 10 years. Sometimes clients say, hey, you should have this, or this area is a little confusing. Can we add, we've got other categories where people can write in things that they have. For example, I spend a lot of money in supplements every year because that's how my doctor helps manage our health. So it's not just me, but my kids. And so that's an area, and that's in here, vitamins, supplements. But I hear people also say, wow, hair, nails, and facials, didn't realize I spent that much money, hair, nails, and facials. Most people have some kind of idea of what they want to spend in these areas here, vacations and holidays. And that's good. But sometimes that's much higher when you really get into it. And then we also have, I told you, we've got different expenses that last different times in your life, whether it's mortgage compared to insurance and whatnot. But there is also travel. So some people, they'll come in and they'll say, we need to spend $10,000 a year. This is typical for travel, but we want to spend $35,000 for the first 3 years. Well, of course, that's different, right? You can't just average $10,000 a year and have $35,000 spending in the first 3 years. You can't, averages aren't good when you're talking about, well, my average expense is going to be this. We want to understand what your real expenses are. We'll work out the inflation. We work out what should drop off, what shouldn't drop off. But this is just the starting point. You've got to really go through the details of it. And with travel, by the way, we usually run this to about age 85, and then we'll drop off travel. Most people stop. But if you tell me, well, no, I got a lot to do. I've got a plan and I want to spend well past 85, that's fine. But the real impact is that by the time you're reducing costs on travel, you're going to be increasing costs on medical, most likely, right? As long as you're still with us at that age. So we'll by that time, your travel costs are reduced, but those out-of-pocket costs are going to be significantly higher. And then we put in what we call what-if scenarios. Well, what if you have a long-term care event, and you need $100,000 to $150,000 per year in today's dollars? And another mistake people make is that they think that this long-term care event will be on average 3 years, and that's not the case anymore. The average is more like 5 years, and the average claim for dementia patients, which is obviously a big issue, dementia and Alzheimer's, is 8.2 years. So that is concerning, right? Dementia, not Alzheimer's. I don't know the average for Alzheimer's, but I do know the average for dementia. So you want to use something like this to really dig in and get and get an answer to really what those expenses are. Yes, it's a pain. It's a lot of work. You know, you have to spend time with it. We have a meeting just on this information. So after we do the financial planning engagement, we collect all this information. We schedule a follow-up meeting just to go through questions. Well, you said you spend X on this. Does that include this, 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 and this? So we'll spend an hour and a half, 2 hours just answering these questions. And then, of course, you do it again the next year. And what often happens is we'll say, we'll have you complete this for the second year. We send you the previous year. And we keep records of these so we can kind of see a trend. But what's not uncommon is that something will be missed. Even though you did it the year before, even though we give you the record, people will say, well, you said $5,000 for pet care last year, for example. Did something happen? You don't have any pet care on here. And you know, maybe an animal died, and it happens, of course. But often it's just forgotten about. Oh, you know what? Geez, I didn't write that in there. I can't believe I didn't write that in there. So we go through and kind of audit it to make sure that it all is right. But that's a lot of work. Listen, I don't enjoy doing it for myself. I have to do it not only for ourselves, but our business and, you know, the financial planning business, the real estate, but you know, it's no fun. Nobody enjoys it, but you should get satisfaction out of it. The satisfaction should be when it's all done. You should have a strong comfort level. I know what the risks are, the iceberg under the oceans. I just, you know, I didn't plan that. I kind of like that analogy though. So you may hear it again. So the iceberg under the ocean, I understand what those risks are, and I'm working to avoid it, work around it, see how we need to do what we need to do to either just go a different path or build ourselves up for it. So, but without it, you're coming really close to that berg. And you know what? You all know the story. You all saw the movie or know the story at least. So it didn't end well for those folks, many of those folks. But I hope that's helpful. I do have a question. Let's just see here. Okay. So Gerard is, hey, Gerard. So Gerard is asking, how have you factored in funding cash outlay for long-term care, $10,000 per month? Well, we're going to talk about that next week. We're going to talk about your income and withdrawals and how to fund things. So first, of course, you have to identify those expenses and get a real idea of those costs. And if you're a planner, advisor, broker, insurance person, whatever, takes you for your word of it when you say $5,000 a month, $10,000 a month, doesn't ask for details, move on, folks. You're not being properly served. I'm certain you're being charged the same. So get the value out of the fees you pay and get, make sure you're doing all the work. So Gerard, great question. How have you factored in funding cash outlay for long-term care? We're going to talk about it more next week. But the real story is that is one of the most challenging things in retirement, and you have to have multiple sources to draw from. Most people can't fund long-term care with one source, so you have to have multiple levers to pull to fund that, or buckets to reach into, whatever analogy you want to use. But good question as always, George. Thanks for joining us. Okay, folks, it's 10:57. Have a great Tuesday. Have a great week, and we will see you next week. Take care.